Hello everybody, welcome back to another valuation investing video, and today in this video I'm be going over three stocks that I believe that are trading at insanely cheap valuations that I think we should be paying more attention to. And some of these stocks probably you guys have heard of, obviously, and are probably well known. I have covered some of these stocks on this channel, not all of them, but I think one or two of them I've definitely covered a decent amount. Another one hasn't been covered much, but these stocks are trading at insanely cheap valuations. But let's get into whether or not we should be buying the stock. So we have to take a look at not just the valuation of a company, but we have to take a look at how that valuation will factor in to the future returns, because just because a company looks pretty cheap and is trading at a cheaper stock price doesn't mean that we should be buying the stock right now. So let's get into these three stocks. So the first stock that I believe is trading at a very cheap valuation that we should definitely take a look at is PayPal stock. If you didn't know what PayPal does, they're basically a transaction fintech company. They also offer basically just online transactions. So this industry is pretty diluted. That's the only problem with PayPal, which I don't like about this company. They don't have a great moat, but they do offer some good moats and they have really good security. But I would say that we have to be careful with this company due to the lack of moat that PayPal has. But nonetheless, this stock is trading at a very cheap valuation. I think its PE ratio right now is at 14, meaning you're paying only $14 for $1 of earnings per share. And keep in mind, the market's trading at about a 25 PE ratio. So PayPal is trading at a very cheap valuation, but let's get into PayPal as a whole. So if we take a look at PayPal stock right here, let's take a look at our 7-step stock analysis. As we can see here, this looks like a pretty strong candidate as we see with the fundamental criteria. Keep in mind, this is just a quick overview of the fundamentals, so don't necessarily think that we should be buying this stock just because the fundamentals right here look good, but keep that in mind. As we can see here, forward P ratio, like I said, trading at a very cheap P ratio. The return on invested capital is barely over 10%, so at least it is over 10%, but they're not amazing at reinvesting back into the business. Revenue growth at about 8%, EPS growth 15%. So the growth rate's pretty good. Let's go over to the financial history here. Taking a look here, we can see the revenue here growing every single year. That looks good, but the net income doesn't look great over the past 4 years. So that is a slight concern. Profit margin is slightly going down over time, which also isn't a great sign, but the shares outstanding are decreasing pretty fast. So I like that they're buying back shares. As we can see here, they're buying back at 5% each year. So this is very good. So if you didn't know, buybacks actually help us investors. If you own this company, you'll actually own more over time as they buy back shares. The only bad thing I don't like here is the debt to free cash flow of 12. This is a very high debt to free cash flow, meaning they can't pay off a lot. Their debt's going to take a long time to pay off with their most recent free cash flow numbers. So keep that in mind. Also, analysts do expect them to grow about 5.1% revenue growth. So that's about in line with what I want. So not terrible, but not great, even though it's 6 out of the 7 key metrics. Some of the metrics are barely check marks, so keep that in mind. So let's go over to my intrinsic value calculator here. And if you guys want to go and check this out, just go down in the link in the description, check out my Patreon 7-day free trial. You get full access to this entire website, and you also get access to the Patreon. You get access to chats with me, and I'm going to be talking about my opinions on stocks. You can also ask me questions about my opinions on certain stocks. So with that being said, go down below, 7-day free trial, and then it's only $8 per month. So go ahead and check that out. But let's get back into PayPal. So like I said, PayPal I think is probably in the future, I think deceleration of growth. So bear case, let's say they grow 4%. Let's do base case, say they grow 6%, and bullish case 8%. I think this company is going to start to struggle in the future as time goes on. Their deceleration in growth doesn't look great for PayPal. Taking a look at the profit margin here, they have a 14% profit margin right now. I think over time, bear case, let's do a 13%. Say it does slightly decrease. Base case, 15%. Bullish case, 17%. I see it staying right around where it is today, just because I don't think that they have a lot of room to increase that margin. Now for the PE ratio, for a company growing at only 4%, I think a fair PE ratio would probably be about 13. Base case, I think a fair PE ratio would be probably 16 maybe. Bull case, I would do 19 PE ratio. I don't think this company deserves a huge PE ratio. Now for the shares outstanding, let's do bear case, they buy back. Let's just do 2% just in case. Base case, let's do 3. Bullish case, let's do 4%. With that being said, right now, the calculations look pretty decent for PayPal stock. Right now, base case, I think you can make a 9% return. So it looks pretty decent at this price. I think bull case, you can make 19%. If you believe these bull case assumptions, you would make a very good return on PayPal. And if you want to get a 10% return, it would be under $64, I think. So if it got under $60, PayPal could be interesting. The only thing I don't like about this company is that their future growth doesn't look great. And if you didn't know, the stock market, the main thing about getting a good return in the stock market, Peter Lynch always said, is that you want their earnings per share to grow over time. That's where the stock returns come from, is the earnings per share growth. And I think this company isn't going to be growing by a huge margin. So keep that in mind with PayPal stock. And with most of these stocks, there is going to be slower growth in the future, probably because of the cheap valuation they're trading at today. Now, the second stock that I'm be looking at is actually going to be Adobe, and I've made plenty of videos on Adobe stock, and I believe Adobe is still an interesting company to potentially look at, but I do think there's definitely some concerns about the future with Adobe due to AI potentially taking over, but I do think that is overblown. And I do honestly think that Adobe won't be going anywhere in the future. So let's get into Adobe stock. I think Adobe's trading at a pretty cheap and reasonable valuation. So taking a look here at Adobe's 7-step stock analysis, we can see we get 7 out of the 7 key metrics. Forward P ratio pretty low at 17.5. Return on invested capital very good, 21.6%. Revenue growth pretty good, near 11%. EPS growth 7.5%. Shares outstanding are decreasing at about 2.5%. Debt to free cash flow very low. Future revenue growth at about 10%. So this looks good for Adobe stock. Looking here at the revenue history, very consistent. Only thing I don't love here is the profit margin continues to go down, which is slightly concerning. Shares outstanding also going down though. That's good. So with that being said, let's go to Adobe stock. So with Adobe, I think that in the future, they're probably going to be growing at low double digits or high single digits. I think they'll continue to grow at a decent rate. So bear case, I think 7% is fair. Base case, let's put 9%, and bullish case 11%. Now for the future profit margin, their profit margin right now is at 30%. So I think with the profit margin, say bear case, it gets down to 27. Say a lot of pricing competition does hurt Adobe, and say AI starts to hurt Adobe's profitability, that could be an issue. Base case, I'm going to put a 30 profit margin, and bull case 33. Now, for the future PE ratio, I think Adobe deserves probably, let's do a 17, 18, let's do 18 PE ratio. Base case, I think this company deserves a 22 PE ratio. Bullish case, let's do a 26. Now, for the shares outstanding, let's put this at 1.5. Base case 2. Bullish case 2.5. That's about where they're doing it right now. That being said, Adobe looks pretty decent here. 9.3% annual return at this price with pretty conservative numbers, I believe. And yeah, that looks pretty interesting here. So with that being said, looking at Adobe here, we can see that we actually get some pretty interesting returns. About 10.4% annual return, I believe, for Adobe stock. So that looks pretty decent here. 10.4% return looks pretty good. Also taking a look, I think it's pretty good right now, I think, for Adobe stock to make at least market average returns. Like I've said in the past though, I would like to see Adobe under $330 to start to get really interested. Me personally, I do not own Adobe yet, but I would be interested if it got especially under $300. That is the key spot, I think, for Adobe stock. So with that being said, that's what I think with Adobe, and that is the second stock that I'm going to look at today. Now let's get into the final stock. Now for the final stock that I'm going to be looking at, this might be a surprise to some of y'all, but it might not be to people who watch this channel, and it's going to be a stock once again that I own, and it's my largest position. And although this company has had a huge run up in stock price, I still think it's pretty cheap, me personally. And this stock's going to be Google. I think Google, in the past videos, I continue to say that I think Google will continue to beat other companies in the AI race. I think their AI continues to accelerate Google search. We saw that in that recent earnings report that it's actually helping them. So I think Google is in a prime position for future growth. And I still think it's trading at a very cheap valuation due to multiple factors, as we saw with the DOJ actually announcing that they're not going to break up Google Chrome. So no worries about that with Google. Also, we've had reports that Google Gemini, which is their AI, is now in the top in the App Store. So a lot of people are starting to utilize Google Gemini. I actually do use Google Gemini over ChatGPT. So I do think that Google is poised for some good growth in the future with AI. And I still think it's very cheap, near all-time highs. So let's get into Google stock. And taking a look here at Google stock, we have 7 out of the 7 key metrics. Forward P ratio, like I said, it is pretty high, but I still think it's a decent valuation for Google. 27.5 forward P ratio. Look at the return on invested capital, 27.7%, very good. Revenue growth, a near 11%. EPS growth near 16%. Shares outstanding going down at 2.5%. The debt to free cash flow looks amazing. Future revenue growth also looks very good. So let's go over to the financial history. Taking a look, the revenue growth looks very good. Net income looks pretty good. We did have that big dip back in 2022, but that is when we had a bear market. So keep that in mind, but that looks good. Profit margin looks pretty good, getting back to where it was back in 2021, and the shares outstanding continue to go down. Google's one of the best at buying back shares, so I really like that about Google. So now with the revenue growth, I think bearish case, Google will grow at about 8%. Now for the base case, I truly believe they can grow anywhere from 10 to 11% base case. I think Google is continuing to grow at a great pace. Let's just do 10.5% just in case, because I don't think bullish case, I think they're not going to be able to grow near 15%. I don't think that's going to be possible for Google, but we never know with how AI could potentially help Google in the future, so keep that in mind. So with that being said, bullish case, let's put 13% revenue growth. Now for the profit margins, right now they're at about 31% profit margin. So I think bearish case, this company could have a 28 profit margin. Base case, I think it will stay at 31. Bullish case, 34. So with that being said, let's do the future PE ratio. Company growing at 8% like Google, pretty good moat. I think deserves a P ratio of at least 20. So let's just put 20 conservatively. Now, base case, I think this company deserves a 24 P ratio. Bullish case, 28. Now, finally, let's do the shares outstanding right here. And with these calculations, I still get Google at a 10.8% return on your investment if you bought today, with a projected price of $412 in the next 5 years. I think if you want a 10% return, bearish case, if it's under $167, you should be loading the boat on Google, and that's what I was doing. My average price is at $157. This is my biggest position. So you could say I am biased, but I personally don't believe I'm biased. I still think this company is still one of the best valuations out on the market. This could be your best company out on the market, even though it's near all-time highs. And I'm honestly interested at buying this company in the low 200s. I really like Google stock. I've liked it for the past few years, and we're finally starting to see good returns out of Google. So with that being said, thank you guys for watching this video on 3 stocks that I believe that are trading at very cheap valuations and that could be good buys today. So thank you guys for watching this video. If you want to go check out the Patreon, just go down in the link in the description, sign up. It's easy, 7-day free trial, cancel anytime. So thank you guys for watching this video. Please subscribe and see you.